a few more words and then we can open it for questions. We really came with two messages today. One is that it's time for the Obama administration to start working with our worker-friendly investment pioneers, our pensions and other institutional and investors, and the millions of members in this labor movement to help rebuild this country, instead of relying so heavily solely on Wall Street mega banks and bailing out banks that don't re-lend to businesses and that employ working people. And it's also time that the administration and Congress pass real financial reforms. We believe if we pool our investments, we could achieve results on a grand scale. If we co-invest with new government partnerships, we could build the green industries of the future, and we could train a new generation of workers. We know how to build and make things that we need as a society. We know how to drive real economic revitalization efforts in our communities. And many of the organizations and individuals who have been leading that charge, such as Landon Butler, Dan Pedrati working in the Office of Worker Investment, and others here from AT&T, Ulico, and UKIPA, and others, have been doing this every day for the last 30 years, many of them, and have been taking a lead in both investing in a way that's long-term, that's prudent, but also yielding a good investment for pension members, pension beneficiaries, and then also creating a lot of benefits for their members and for communities. The second message is that, unfortunately, pension funds were also used in the run-up to this last major financial crisis, and pension funds were used by Wall Street banks in such a way that they were flowing into the subprime mortgage market. You may have seen an article where CalPERS lost $1 trillion on investing in securities that were invested in subprime mortgages. They were invested in hedge funds, and hedge funds had been investing in such bad investments connected to so many different kinds of derivative schemes and credit swaps that when Lehman Brothers collapsed last September, many of the hedge funds which were investing pension money basically went down with the Lehman Brothers collapse. The state of Pennsylvania, for instance, the Pennsylvania Public Employees Investment Fund had invested 30% of their total portfolio into hedge funds, a hedge fund strategy, which were protected by credit swaps. And so I actually had a meeting with Pennsylvania CERS in June of 2007, and I asked the simple question, why aren't you investing in organizations like the Housing Investment Trust who are building low-income, affordable housing units in Pittsburgh and in Philadelphia? They're building commercial buildings, they're building multifamily units, they're building workforce housing, and many other funds like MEPT and Ulico were building around Pennsylvania as well. So why wasn't the Pennsylvania pension funds investing in those kinds of investments? And the answer was, well, because we're making more money on hedge funds. And it is true that they did make more money for a short term, and then as we saw in this last crash, many of those public pension funds like Pennsylvania, Massachusetts, New Jersey, which had overinvested in hedge funds, saw a huge loss of capital. And in fact, when all the dust settled, $5.4 trillion of pension funds were lost around the globe. And we have to say that Wall Street was a big, one of the drivers of those losses because of investments in very shaky and very risky bets. And then the last sort of point I want to make about bad investments or irresponsible investments is something that Bob mentioned, major funds going into, major pension funds investing in these Wall Street LBO funds, as they used to be called back in the days of the barbarians at the gate, the leveraged buyout funds, which are today are called mega private equity funds, which are basically have been invading Europe in the last 4 or 5 years, as we've seen, but have been buying companies up, lock, stock, and barrel. They're now some of the largest employers in America and now in Europe. And as Bob said, they're overloading many of those companies with debt. They're pulling the assets out of those companies. They're stripping and flipping those companies. And so that those companies are the ones that are closing as soon as there's a problem in the economy. So companies like Simmons, in terms of bankruptcies, closings, companies like Mervyn's, companies like Linens and Things, companies which have had good labor relations for decades are now closing or going bankrupt because of bad investments using workers' pension funds. So I'll close with the final comment that it doesn't have to be this way. We've talked about these kinds of investments in what are called alternative investments. And instead of investing in rushing to this get rich quick scheme, which many of our investors seem to want to do, we are asking that America's pension funds and capital stewards and labor unions, with the help of our administration and Congress, take a second look at the kinds of investments that we've profiled in this book. Investments that are building affordable housing, workforce housing, rebuilding cities, investing in advanced manufacturing, investing in windmill companies, investing in solar companies, investing in efficient transportation companies and hybrid buses and those kinds of investments. Take another look at the long-term investment strategies that also make good money, bring a good return, but also create good jobs and good housing and living spaces for union members, but also for members of society at large. So I want to thank all of you for coming, and we're open for questions. Thank you.